Good morning, friends. Good morning. Okay, let's continue with the discussion. In the previous session, we have started with an area called mutual fund. What we learned in the segment is it is an instrument for long term wealth creation. There are multiple parties which are there in a mutual fund. There's a sponsor who initiates a mutual fund, there's an AMC which manages the operation, there's a trustee who oversees things, ensuring that all rules, regulations are followed by the MF. There are unit holders who give the money, and there are MF distributors are an organization like Association of Mutual Funds of India or SEBI, which will put certain rules. We learned that how do I compare my return versus the mutual fund return, because every investor on his own can make investment. If I make investment on my own, I'll be able to earn 10% return. I would want the MF to earn 12 or 13% so that I get my 10%, for which there is a relationship which was said: own return, MF return, is equal to own return divided by 1 minus IER, initial expense ratio, plus the annual expense ratio. There is a recurring expense which is going to be incurred. This, if the MF earns 12-13%, I will get my 10%. If the MF is earning 12-13%, I'm going to get my 10%. That's the broad thing we learned. We also learned that apart from the straight linking, there's also a possibility of an opportunity cost. Opportunity cost arises because when I do my direct investing, I have to spend time on managing it. And when I spend time on managing it, obviously what will happen is I have to lose out something. So that could be a loss in my regular income. So instead of doing teaching, if I just spend some time on managing my portfolio, and that takes away, assuming from 9 to maybe 12, and that's the time I could have taken some other batches, whatever income I'm losing will be an opportunity cost for direct investing, or benefit for MF investing. If you do MF investing, it is a benefit because it will increase your income level, and if you do direct investing, it is an opportunity cost. This is what we broadly saw in the previous session. We saw two concepts. One is MF return versus individual return straight away comparison, then an MF return versus individual return and opportunity cost comparison. The third segment I'm going to start today, the third concept, the concept book has numbered concepts. I think around 20 to 23 concepts are there in mutual fund chapter. Our focus would be on learning each of the concept. The third concept I'm going to talk about today is on something called as return. Now, nothing for you to look at in the book. Listen for some time. Now, what there are multiple formulae of calculating return. You would have learned about return on equity, return on investment, return on assets, return on capital employed. So there are multiple ways of getting the formula for return, but the common theme is very simple. The return formula is, I don't want you to write anything, be in listen mode. Return formula is what I get back minus what I give divided by what I give. This is the simple formula of return. Return is nothing but what I'm getting back minus what I'm giving. So I give 10 lakh rupees to a bank. Bank is giving me back 11 lakh rupees. That extra 1 lakh is my income. That extra 1 lakh is my income. What I get back minus what I give is the formula for return. You would have learned about return on capital employed. What is return on capital employed is what they get back technically is EBIT. What they technically get back is EBIT divided by capital employed. Return on asset, on the asset what they get back, on the asset what they get back is profit after tax. So every net every return formula focuses on what I am getting back, what I am getting back. So when I invest in a mutual fund, I can buy today, sell it after 3 months, 6 months, 9 months, 12 months, 15 months, 5 years, 10 years, 15 years. I can sell at any point of time whenever I wish to. So what I get back is technically called NAV1. NAV1. What is NAV1 is? NAV is like the market price of a share. When we have a market, you learn about NAV calculation in this chapter. But like for an equity share, we have market price. For a mutual fund, we have net asset value per share, or net asset value per unit. There it is called market price per share. Here it's called NAV per unit. NAV per unit. Net asset value per unit. So whatever investments I am making, it happens at an NAV, and when I come out again, it happens at an NAV. Again, it happens at a NAV. So NAV 1 minus NAV 0. NAV 1 minus NAV 0. This is my return. NAV 1 does not mean year, first year NAV. For our understanding, NAV 1 means closing NAV. NAV 0 means opening NAV. Depending on, for example, if you are selling after 3 months, the 3-month end is called NAV 1. Day 0 is called opening NAV. Day 0 is called opening NAV. NAV 1 minus NAV 0. Apart from this, when you buy an equity share, I earn P1 minus P0. I earn P1 minus P0. Apart from that, the equity share can give you dividend. The equity share can give you dividend. Similarly, mutual fund can also give us dividend plus D1. The mutual fund can also give us dividend. If I want to calculate return for this property, closing value minus opening value plus rental income. Closing value minus opening value plus rental income. This is return in rupees. This is return in rupees. If you want percentage, you have to divide by something. If you want percentage, you have to divide by something. So return formula, again I'm going to use it in not only this chapter, maybe at 50-60 question we'll be using it. Return formula is very simple. What I get back minus what I give. I don't have any formula. Logic is very simple. What am I getting back minus what am I giving? That is called return in rupees. That's technically called return in rupees. If you divide by something, it will become return in percentage. If you divide by something, it will become return in percentage. If I don't divide, then it is return in rupees. So like I have net profit margin. Net profit is return. If you want percentage, you have to divide by something. There we divide by sales. Here we have to divide by what am I investing. A usual question of the people would be, what return am I going to generate? Now if you tell them that you are going to generate of 20 lakh rupees, he says I don't understand anything, because return is normally understood in percentage. So if I tell that FD will give you 7% return, then you understand, okay, 7% is the income I'm going to generate. If I tell you FD will give you 1 lakh rupees, next question you're going to ask me is how much should I invest? So return is always expressed in percentage. NAV 1 minus NAV 0 plus D1 divided by NAV 0 what I get back minus what I invest divided by again what I invest. It's only not here. I'll be doing equity share in portfolio management. P1 minus P0 plus D1 whole divided by P0. Or this is first year return. Question specifically wants second year return there. P2 minus P1 plus D2 divided by P1. So you can keep doing any number of calculation any year. Logically, this is not the right formula, but this is what you will use in every question. The right approach is going with time value of money, which is IRR return. If at all anybody wants to calculate perfect return, then you have to consider IRR. For example, I'm investing 1 lakh. I'm getting back 10 lakh in 10 years. 1 lakh became 10 lakh, you will say you have earned 900% return. No, that is wrong. Because time value of money is ignored in the calculation. But major chunk of the chapter, we are going to do return only like this. Less than 1 year, practically, return is calculated without time value of money. More than 1 year. Whenever it is more than 1 year, ideally I should go through IRR route. For more than 1 year calculation. Less than 1 year, non-IRR is perfect. Less than 1 year, non-IRR. So my formula is NAV 1 minus NAV 0 plus D1 whole divided by NAV 0. In this, an extra add-on which is not there in the practical world. But in your material, questions keep coming in called CG1. What is CG1? I'll explain. See, what does mutual fund do? It buys shares, sells share. When it keeps buying and selling, it earns dividend income. It can also make capital gain. It earns dividend income. It can also earn capital gain. D1 means dividend given to you out of the dividend earned by the mutual fund. Dividend given to you out of the dividend earned by the mutual fund. CG1 is dividend given to you. Again, it's dividend only. Dividend given to you out of the capital gain earned by the mutual fund. Out of the capital gain earned by the mutual fund. So there's practically no difference between D1 and CG1. D1 is also dividend. CG1 is also your dividend or income. CG1 is also your dividend or income. D1 is paid out of dividend earned by the mutual fund. CG1 is paid out of the capital gain earned by the mutual fund. Capital gain earned by the mutual fund. Net very simple. What and all you are giving me, I will keep adding in the numerator. You're giving me D1, I'll add. You're giving me CG1, I'll add. If I'm doing 5-year calculation, you're giving me D2, I'll add. CG2, I'll add. D3, I'll add. CG3, I'll keep adding whatever you are giving me. Whatever you are giving me will keep adding to my numerator. In the numerator, I'll keep adding D1, D2, D3, D4, D5, CG1, CG2, CG3, whatever I am getting back. Very simple logic. People practically understand only one thing. In the end, tell me how much cash will I get, how much cash I have to give. They don't understand all this. They'll only say only one thing. Tell me what cash will come back and what cash will go out. You reduce stamp duty, reduce STT, all this are incurred. You reduce everything. In the end, give me what will come back to me and what I have to give. This is what return is all about. Return is all about this. People don't understand anything else. You ask anybody, they'll only say how much I have to pay today, 5,000. How much I'll get back? You tell me that amount. I don't want this fancy name NAV1, D1, CG1. All this is of not my worry. So this is the formula for return. Return is NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0. This is technically called holding period return. This is technically called holding period return. NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0. So in your book here you can write what I get back minus what I give, what I get back minus what I give divided by what I give. The formula is page 99 of the concept book. What I get back minus what I give divided by what I give. This is basically the formula for holding period return. What I get back minus what I give divided by what I give. Technically, this formula is also wrong. First of all, IRR is right. Even if you use this, this also has one issue. Let's assume I invest for 1 month. I invest for 1 month and I get an answer as 2%. I get an answer as 2%. If I say 2% return, you will say not a great return, unhappy about it. But the real fact is I'm earning 2% for 1 month. 2% for 1 month, which means 24% for a year, which means 24% for a year, which is where the next formula comes into 12 by M, into 12 by M, which is called annual return, which is called annual return. Holding period return, whatever is your holding period return, into 12 divided by number of months, into 12 divided by number of months will give me something called as annualized return, will give me something called as annualized return. Whatever is my holding period return, whatever is the holding period return, multiply with 12 by M, multiply with 12 by M, you are going to get what? Annualized return. Clear? Any doubts on this? I'll explain again. Holding period return is what I get back minus what I give divided by what I give into 100, least bother whether it's 1 month investment, 5-month investment, 10-month investment, 20-month investment. Then where is the variant coming? The variant comes by adding 12 by M in the formula, by adding 12 by M in the formula. Moment you add 12 by M in the formula, moment you add 12 by M in the formula, it will become annualized return. It is going to become annualized return. Clear? Any doubts on this? Any doubts on this part? Now let's see an example. Opening NAV 20 rupees, closing NAV 21 rupees. Opening NAV 20 rupees, closing NAV 21 rupees. So closing is NAV 1, opening is NAV 0. 21 minus 21 rupee is my earning. Dividend first month, dividend second month, dividend third month. Moment it is declared, it is my income. Moment it is declared, whether it has come to me or it has not come to me does not matter. You will learn about this as we proceed. As we proceed, you will learn about one more concept. So dividend income is 2 rupees 50 paise, another 50 paise, 2 rupees 50 paise and another 50 paise. So my income is 21, 21 minus 20, NAV 1 minus NAV 0 plus 3 plus 3, 2 rupees 50 paise, 50 paise, 2 rupees 50 paise and 50 paise. It does not matter whether dividend is paid or not. You will understand why as we proceed in the chapter. Whole divided by 20 into 100 will give you holding period return. If you do into 12 by 3, that will give you annualized return. Into 12 by 3, if you do, it will give annualized return. What's the number first you get here? 20. It's technically 20% for 3 months. It's technically 20 percentage for 3 months into 12 by 3. I'll get 80%. I'll get 80%. Any doubts on this? So to put it simply, there is a small equation or a formula which I will use. Annual return is equal to holding period return is equal to holding period return into 12 by m, into 12 by m. This I'll use it at few places. I'm going to use this at few places. My annual return is equal to holding period return into 12 by m. Today you go to a bank, ask for FD rates and tell them that you want to invest for 30 days. What effectively we will earn is 0.5% for 30 days. But if the bank tells you 0.5%, you will not buy the FD. So what they will say, 6%, 7%, 8%, because people understand only yearly rates. People understand only yearly rates. What my mind will say, okay, 30 days, 60 days, 180 days, 360 days, 2 years, whatever rates are there, I'll keep saying whichever is the highest, let me go ahead and invest there. I'm not going to do saying that, okay, he has given proportionate, so I have to convert into annual and then do the calculation. All that is not possible at my end. Major chunk of the market, major people in the practical world are not having knowledge of finance, so they are not going to get into doing all this calculation. What they want is annual return. What they want is annual return. Any doubts on this? Any doubts on the concept? So the first main concept I'm done today is return computation, which is not only for this chapter, going to be used in multiple places. Return is very simple formula. What I get back minus what I give divided by what I give into 12 by m into 100. Anything I do in practical world, I would want, for example, you have become a chartered accountant. After clearing your chartered accountancy, you have worked for 2 years. After that, I want to take a break, do some other course, maybe an MBA, and then come back. My first question will be, what is the ROI are you going to generate from MBA? Because you're going to spend maybe 20 lakh or 30 lakh on that. Your income will go up after completing the MBA. So what is the ROI I'm going to generate? If the ROI is worthy, go ahead with investment. Otherwise, ROI is not worthy, I'm not going to do the investment. Every company which does an investment, they don't go by this formula, they go by NPV or IRR, because that has time value of money. That has time value of money. Here also I can bring time value of money. You will understand as we proceed. If I bring in time value of money into picture, that's the perfect return, which we don't follow in most of the areas. In most of the areas, return computation is going to be simple. Reason is very simple. IRR calculation takes little bit more time. Practically, if you look at international courses, they allow financial calculators. There the NPV or IRR can be calculated in the calculator. For us, I need one positive NPV, one negative NPV, guess rate, all this you would have seen at inter level. So then the calculation itself takes up a lot of time, because see, practical world, if you ask me calculate IRR, I'm just going to put it in Excel, and Excel will give me the IRR. You will learn later as I proceed. For IRR calculation, I'm just going to put the data in Excel. Excel will automatically give me the answer. So at least good thing is they are not testing how to calculate IRR, because if testing IRR was there, a question which takes me 10 minutes to solve will take me now 20 minutes to solve or 15 minutes to solve, because we'll unnecessarily waste time on calculating IRR. That could be one reason why ICI is not added more of IRR question and less of this. So more of less of IRR question and more of this formula based question. More of this formula based question. Clear? Any doubts on this? Can you proceed? Get me an answer to this. Very simple question. A very simple question. It's there in front of your screen. Holding period for 6 months is 8%. What is annualized return? Please participate. I have just now explained so much. Is it 16 or 4? Only two options. Is it 16 or 4? 16. Annual return is equal to holding period return into 12 by M, or in other words, 8% per 6 month. Obviously, 16% for a year. 16% for a year. Any doubts on this? Any doubts on this part? Okay. Let's come to question 3. A small question. Question 3. A mutual fund that had a net asset value. Question 3, page 204. Page 204. Question 3. Question bank, concept book. These are the two books which you'll have to keep referring. Theory book you can keep at home. Theory book I wouldn't need you to bring to the class. These two books mandatory for you to bring. A mutual fund that had a net asset value of 20 at the beginning of the month made income and capital gain distribution. Income distribution is dividend distribution. Capital gain distribution is dividend distribution out of capital gain. Dividend distribution out of capital gain of 0.0375 and 0.03 per unit. Ended the month with an NAV of 20.06. Compute the monthly return and add annualized return. Compute the monthly return and add in the question. And annual return. Monthly return and annual return. Let's apply the formula. MF return is equal to MF return is equal to or, yeah, MF return is equal to NAV1 minus NAV0 plus D1 plus CG1. NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0 into 100. This is technically called holding period return or monthly return. They have asked for monthly return. NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0 into 100. Into 100. Questions like this have come in exam. It's not that I'm doing question which have not come in exam. What is the closing NAV? Opening 20.06 minus 20. Dividend distribution 0.0375. Capital gain distribution. So what I get back minus what I invest. What I get back minus what I invest. 20.06 minus 20 plus 0.0375 plus 0.03. Technically, this is my profit. Technically, this is my profit which I'll be recognizing in my books of accounts. Whole divided by 20 into 100. Into 100. Into 100 is to express in percentage. What's the number you get? 0.63 percentage per month. 0.6375 percentage per month. 0.6375 percentage per month or into 12 by 1 into 12 by 1 into 12 by 1. This is monthly return. If it was a quarterly return, I would have done into 4 by 1 into 4 by 1 into 12 by 1 into 12 by 1. What's the number you get? percentage per annum. Question only asked monthly return. I added the annual return part. 0.6375 percentage per month or 7.65 percentage per annum. Any doubts on this? Straightforward, simple question. Done. Can you proceed? Clear? Oh, question 4 came in exam as a reverse working question. What is reverse working? You will understand. They would have given the return and either asked you NAV1 or NAV0 or D1 or CG1. One of them would have been asked in the question. You will understand as I read out. But it's a reverse working question. It's a reverse working question. We just now did a direct working question. May 24 exam. They reversed the numbers. They reversed the numbers and asked the reverse working. Now, only challenges many times students, because of the anxiety factor, they are not able to pick out a reverse working question properly. Let's see this. Mr. A has invested in Grow Rich mutual fund scheme. Details of the scheme are given below. Asset value at the beginning of the month. Asset value at the beginning of the month. This is called what? NAV 0. NAV 0 at the beginning of the month. At the beginning of the month. Annualized return, which means you have to do 12 by m in the formula. You will have to do 12 by m in the formula. Distribution in the form of capital gain and income. Distribution in the form of capital gain and income. Technically, D1, CG1, that is CG1 and D1, CG1 and D1. Calculate the month end NAV. Calculate the month end NAV of the Grow Rich mutual fund scheme. Provide a brief comment. The second part, I really got irritated when ICI asked a question. You will see the comment which ICI has passed. Doesn't really matter. I don't know what kind of question is that. You will understand when I do the second part of the question. You will understand what comment ICI has added. But okay, I cannot deviate from what they have done. First part is a very good question. First part is a very good question where I just did in the direct order. Now I'm going to do it in the reverse order. I'm going to do it in the reverse order. Before I start, be little cautious when you do reverse working. 2-3 reasons. You write this number, no numbers, never percentages there, be very careful. MF written, if you write 0.6375, then the other side will have into 100. Then the other side will have into 100. If you write 0.6375 percentage, technically into 100 should not go in the other side. Reason is, moment you do into 100, calculator gives you 0.6375. Calculator does not tell you 0.6375 percentage. When you do into 100 in the calculator, the number which you get is 0.6375. I say because we are multiplying with 100, final answer we will write it as percentage. So whenever you do reverse working question with the percentage, in this question it says 16. If you write 16, other side will have into 100. If you write 0.16, don't write into 100 in the other side. If you write 0.16, don't write into 100 in the other side. Be cautious about this. These are common mistakes which students make. Whenever you work with percentages, it will lead to, see, when I do direct working, no problem. Last question, nobody would have got a doubt why we are adding a percentage and all. You will think when I write into 100, other side will be 0.6375 percentage. No, into 100, mathematically the answer comes as 0.6375. Calculator did not give you 0.6375 percentage. Calculator only told you what? 0.6375. I said we are multiplied with 100, so we will write it as percentage. Otherwise, your answer is not 0.6375. Your answer was 0.006375, something like that. I can leave it there also. I can leave the answer there also, but people will not understand. People understand what? Percentage. So we have converted into percentage, but reverse working question. Reverse working question will have to be little cautious. Clear? Let's start. Question 4. Question 4. Same formula. MF return is equal to, I'm not doing into 100 in the formula, okay? MF return is equal to NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0. No into 100 in the formula. MF return is equal to NAV1 minus NAV0 plus D1 plus CG1 weight. What is the return given in the question? Annualized return or normal return? Then into 12 by M. Into 12 by M. Initial set of question. I'll go Try to go very slow so that we get the grip. As we proceed, certain concepts will be clear. Then I can pick up the speed. Any doubts till this? Now, 2 3 points before we start. Practically, NAV in the practical world, for example, practical world, NAV it says 89.0106. So NAV practically can go 2 decimal, 3 decimal, 4 decimal. The NAV can be practically. When you buy a mutual fund, when you buy a share, you can buy 1 share, 5 share, 10 share. Mutual fund, you can buy 1.2345 units. You can buy 1.2345. Practically, what happens is, I will be investing 1000 rupees. I'll give mutual fund 1000. What he will do? 1000 divided by 89. 1000 divided by 89, and he is going to give me something like 111 point some number. It is going to be in decimal units, as well as NAV, as well as NAV, both will be in decimals in the practical world. How many decimals depends. For example, if the same NAV was something like 500 rupees, there maybe 3 decimal is sufficient or 2 decimal is sufficient. The same NAV is like 10 rupees, there 4 decimal makes a difference. So depends on what is the absolute number I have. If I have 10 rupees, I need more decimal. If I have 1000 rupees, I need lesser decimal. I need lesser decimal. Units, if I'm allotting you hundreds of units, I'm okay. But if I'm allotting 1 unit to you, then I would want maybe 4 decimal. So practical world, most of the times when I have invested in mutual fund, I've seen 4 decimal numbers for units and 4 decimal numbers for NAV. This question, they clearly mention round off to 2 decimal. I do my calculation, NAV is to be rounded off to 2 decimal. If clarity is not there, I would have done 3 or 4 decimal. I would have gone with 3 or 4 decimal. Clear? Let's start now. Is a return given 0.16. 0.16 is equal to NAV1, which is what I'm calculating. NAV1 is what I'm going to calculate. NAV0 is how much? 78.5. D1 0.3. CG1, again I'm repeating, D1 CG1 doesn't really matter, it is same for us. Divided by 78.5 into 12 by 1. Let's take 78.5 to the other side, 12 also to the other side. Let's take 78.5 to the other side and 12 also to the other side. So you will get something in the left hand side is equal to NAV1 minus 78.5 plus 0.3 plus 0.4, and ultimately NAV1 will come. So this side is going to be 0.16 into 78.5 into 78.5. Whatever 78.5 is there in the denominator, I take it to the numerator other side, divided by this should be the numbers. Net it will be 1.05 is equal to NAV1 minus 77.8. The NAV1 you got 78.85. Just to cross check a reverse working question, you put 78.85 in the calculator, minus 78.5 plus 0.3 plus 0.4, divide by 78.5 into 12 by 1, check whether you're getting 16%. Check whether you're getting 16%. Just to cross check the answer. Just to cross check the answer. There are possibilities of we making mistake in a hurry. 78.85 minus 78.5 plus 0.7 divided by 78.5 into 12 divide by 1 into 100. I'm getting some 16.05%. That's rounding off. That's rounding off part. So NAV1 is 78.85. Now, comment, I cannot help it. Very disturbing comment this is. Closing NAV is increased by 0.35. There is a slight change in NAV. I don't know what a chartered accountant is going to do by writing a comment like this. Doesn't make any sense at all. But they have asked something like this and they have commented like this. See, logically, if at all I want to make some decision making comment, I can accept it. But a comment like this is just waste of time. It technically is waste of time. I don't know what are you going to get out of this. You can write the comment, you can copy the comment. I have nothing to explain here. Closing NAV is increased by 0.35. There is a slight change. I think ICI should, I'm not commenting anything here. There's nothing there I can comment on this question. Ideally they should not have asked this part. They should not have asked the, unfortunately this would have been a 6 mark question. First part could have been 4 marks. Second part, the student would have also thought what to comment on this, because you will also be thinking what to comment. When I saw the question earlier, there was one question in your SM. In SM, the answer came as 78.5, closing also 78.5. So comment was there is no change in NAV. There is no change in it. So it's not that it was a new thing by ICI. They added in SM and then they made it in May 24 exam. Okay, comment is this. Let's go ahead with whatever they have given. Any doubts on this? Clear? Can you proceed? So we have just focused on the return computation. Return computation, there is going to be more and more focus as we proceed on. There are certain extra add-ons I'll keep adding, but broadly this is what I initially wanted to start on the return. Return is your what I get back minus what I give divided by what I give into 12 by m into 100. Clear? Any doubts on this? I have something called as a close-ended scheme and open-ended scheme. Let's understand this first. You're going to do a question on this. So let's first understand this properly. We have two types of schemes in a mutual fund. An open-ended scheme, I can buy today and I can sell it tomorrow. I can sell it tomorrow. Buy today, sell it tomorrow. From whom I'm going to buy? From the mutual fund AMC. Whom I'm going to sell? Mutual fund AMC. So mutual fund AMC will give me the units. I will pay them, and if I sell, they'll give me the money and I'll return the units to them. There's something called as a close-ended scheme. What is close-ended scheme is? MF is saying he will have 1 crore units and I put a stop. That's all. I'm saying you don't come back to me and all. You don't come back to me saying that you want to redeem it. I have 1 crore units. I make an issue and close it. That's all. Then what as an investor you can do? It is mandatory that this needs to be listed. A close-ended scheme, mandatory, it has to be listed in the stock exchange. Moment it is listed, you can buy it in the stock market, somebody else will sell it. Somebody else will sell it and you can sell it in the stock market. Somebody else will buy it. Somebody else is going to buy it. So in a close-ended scheme, there will be a date at which the scheme will get over also. That and all the scheme will tell. But the working here is very simple. In a close-ended scheme, I'm not going to buy from the mutual fund. I'm not going to sell to the mutual fund. When I buy or sell from the mutual fund, the buying or selling happens at NAV1 and NAV0. NAV1 and NAV0. What is NAV? It is basically the fair value of the unit. Fair value of the unit. You will understand as we proceed. When it's a close-ended scheme, it is listed in the market. When it is listed in the market, today the fair price of TCS is 1000. But in the market, it can quote at 1100, 1050, 1020, 1030, 1050 because market works little irrationally. And what is so our formula is going to remain same for close-ended scheme. NAV1 minus NAV0 plus D1 plus CG1. But NAV1 will have to be adjusted for some premium or discount. NAV1 will have to be adjusted for some premium or discount. Same way NAV0. Same way NAV0. I'll just give you an example. International MF schemes, why some funds are still taking money and so what happened is there are certain international mutual funds. RBI suddenly put some restriction saying that you cannot take money now from the unit investor. RBI put some restriction on that. Moment RBI put restriction, so MF is not able to buy or sell to you guys. So what happened? It is available in the market. It is available in the market because it was a listed product. Became listed product. It is available in the market. Indirectly, if the NAV is 10 rupees, people were ready to buy or sell at 11 or 12. People were ready to buy a premium because somewhere I wanted that. I wanted those international exposure, but RBI put some condition. RBI put some condition because of which I am not able to take the money from the unit investor. So whichever close-ended schemes were available, whichever close-ended schemes were available for international funds, indirectly what happened is because you are not able to participate in an open-ended scheme, there could be a buyer, there could be a seller. NAV practically is determined once a day. But in a close-ended scheme, buying price and selling price is determined from 9:15 till 3:30. Throughout the day, the price can keep changing. The price can go up. The price can go down. So for a close-ended scheme, formula is same. What it says is a close-ended fund is an investment fund with a fixed number of units which are traded on the open market, which are traded on the open market like stock, which are traded on the open market like stock. NAV of a close-ended fund may differ from its market price or technically fair value, may differ from its fair value, often trading at a premium or a discount, often trading at a premium or a discount to the NAV in the market, to the NAV in the market. Therefore, when calculating returns or assessing performance, the opening and closing NAV, the opening and closing NAV should be adjusted for what? Premium or discount. In the formula, NAV1 will not be the real NAV. It has to be slightly more or slightly less. NAV0 will not be the real NAV, has to be slightly more or slightly less. NAV on 1/1/2014 is 10 rupees. NAV on 1/1/2014 is 10 rupees. Closing NAV is 12. Dividend and capital gain distribution is 0.5 and 1.5. If you tell only this, NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0, NAV1 is 12 rupees, NAV0 is 10 rupees, 12 rupees and 10 rupees. Then they are saying on 31/12/2014, the unit was trading at a discount of 2%. 1/1/2014, it was trading at a premium of 2%. It was trading at a premium of 2%. So whatever NAV given in the question, one has to be increased by 2% and one has to be reduced by 2% because one of them was quoting at a premium and one of them was quoting at a discount. So 10 rupees which is there in the question is wrong. 10 rupees which is there in the question is wrong. Opening, trading at premium or trading at discount. What does the question say? At a premium of 2%. So it is not 10 rupees. In the formula, it is 10.2. In the formula, it is going to be 10.2. 12 rupees is trading at discount. So it's not 12 rupees, it is 11.76. 10.2, 11.76. If it was a open-ended scheme, return is 12 minus 10. For a close-ended scheme, return is 11.76 minus 10.2. 11.76 minus 10.2 because I cannot buy it at 10 rupees and I cannot sell it at 12 because it was quoting at some premium and some discount in the market. Unfortunately, when I purchased, it was quoting at premium, and when I sold, it is quoting at discount. That is going to reduce my return. But whatever it is going to reduce my return. So the calculation is going to be 11.76 minus 10.2. 11.76 minus 10.2 plus 2 rupees plus 2 rupees whole divided by 10.2 into 100. Any doubts on this? No. So NAV is what is the real price in the what is the real price declared by the mutual fund. Mutual fund will have to give NAV every day. Will have to give NAV every day. It gets declared by night 11 o'clock, 12 o'clock. So by night 11 or 12, every day mutual fund will give its NAV. How it gets is as the share prices go up, go down, the NAV will come out by 11, 12. Trading happens throughout the day. Trading happens throughout the day. So at the end, they say 10 rupees. But in the market, it was at 10.2. In the market, it was at 10.2. At the end, they said 12 rupees. In the market, it is at 11 points. Will this always quote quote at premium or discount? No, it can be very close. It can be very close. 1-2% and all practically possible, but ideally both has to be same. Ideally both has to be same. See, if given a choice, the same fund you could have purchased for 10 rupees, but it was not there, so you paid 10.2. You paid 10.2. It's worth only 10 rupees. It's worth, you know, it is worth only 10 rupees, but you are paying 10.2, like that international mutual fund where you are okay to pay extra, where you're okay. People paid even 10-12% extra that time, saying that I wanted international exposure. I want to invest in maybe Google and other companies, so I want that exposure. So I'm okay to pay a premium. I'm okay to pay a NAV is the number which is without the premium or discount. Without the premium or discount. Any doubts in this first? If it's clear, you're going to do a question. So if there is a doubt, let me know. If there is a doubt, let me know. I'm going to give you a problem you're going to do. I'm not going to do it. So in case there is any doubt in this understanding, you will have to tell me. I'll repeat again. NAV1 minus NAV0 D1 CG1. It's technically into 12 by M, but 12 by M is 12 by 12 in this question. 12 by M is 12 by 12 because it is a 1-1-2014 31-12 31-12 2014. So technically it was 1 year. It was 1 year. So holding period return, annual return, both are same. Both are same. NAV1 adjusted as well as NAV0 is adjusted. Both have been adjusted by us. Clear? Any doubts on this? Any doubts on this? Okay. Question 6, which is a homework question. I will give it to you. I am not even reading it. I'll give you 5 to 6 minutes. 5 to 6 minutes. It is technically a homework question. I could have left it also, but initially I want you to practice in the class itself. 5 to 6 minutes for you. Start solving question number 6, page 205. Page 205, question number 6. We'll quickly discuss the answer. Formula remains same. It is a homework question. There's nothing much in the question. NAV1 minus NAV0 plus D1 plus CG1. NAV1 is my 28.8. 28.8 with there is a premium of 3%. With there is a premium of 3%. So 28.8 plus 3% premium, 29.664. Opening NAV 0, 28, 28 minus 5%, 28 minus 5%. There is a premium of 5%. 28 minus 5% will be 26.6 plus there is a income and capital gain. There is an income and capital gain of 2.8 whole divided by 26.6, whole divided by 26.6 into 100, whole divided by 26.6 into 100. 29.664 minus 26.6 plus there is a dividend income of 2.8. There's a dividend income of 2.8 whole divided by 26.6 into 100. The answer we got is 22.05%. 22.05%. Very simple question. Again, my focus is going to be getting full clarity on the concept. Practice will automatically happen. Any doubts on this? Now I'm going to go to the next concept. It's not NAV. It's not NAV. I didn't want to change the formula. I didn't want to change the formula. It is basically MP1, market price 1. The formula is MP1. I didn't want to change the formula. Basic logic is NAV1, you adjust the value. But the formula, real formula is MP1, P1 minus P0. P1 minus P0. It is not NAV1. The real formula is P1 minus P0. Any doubts on this? Okay. I'll come back to question concept 5, 6 and all later. I'll come to concept 8. I'll come to concept 8, which is on an area called dividend payout and dividend reinvestment. I'll first explain this. See, when I invest in a mutual fund, there are multiple purposes of investing in a mutual fund. A person can invest in mutual fund with multiple purpose. Today, when I invest in a mutual fund, I don't want anything back from mutual fund for the next 15 years. For the next 15 years. For those people, there is a scheme called growth scheme. There's a scheme called growth scheme. What does a growth scheme do? It does not give you any dividend income. It does not give you any dividend income. Also, it does not give you any bonus units. It does not give you any bonus units. So a growth scheme is, I start with, let's assume 10,000 units into 10 rupees. I'll end with 10,000 units into maybe 80, 90, 100, 110, 120. The price will keep changing. The NAV will keep changing, but I'm not going to get any units. Practically, MF has to declare NAV separately for a growth scheme. I'll show you. HDFC small cap fund growth NAV. Growth is, I think, 141.509. Similarly, we have 49.317 is the dividend. 49 rupees is the dividend part, and your growth part was some 141 rupees. The gap you see, would have been the dividend kept on declared by them. You would have kept on getting the money. You would have kept on getting the money. It's the same fund, but I have two different types. One is called a growth plan, where what I do is I start investing and I don't get anything back till I sell the units. Till I sell the units. This is one. This is one. Second type is, I don't know why this exists also, bonus. Practically, I have not seen much, but in your exam question, it will come. Bonus scheme, what will do is, you buy 10,000 units. Today, it is 10,000 into 50 rupees, let's assume. They will declare a bonus. They'll declare a bonus. Moment they declare a bonus, let's assume it's 1:1. It will become 20,000. NAV will become half. NAV will become half. It's not going to, you're going to make extra money and all. Bonus scheme, what will happen? Today it is 10,000 into 50. A day later it will become 20,000 into 25. When can NAV go up? If any appreciation, Nifty is going up, Sensex is going up, all that can happen. But in a bonus scheme, I start with 10,000 units. I may end with 20, 30, 40, 50, 60, 70, 80. I may end up with any number of units, but logically, you're not going to earn anything out of it. You're not going to earn anything out of it. Why bonus is declared? I'll explain as we proceed for a share. But for mutual fund, there is no use of declaring bonus. The third part which I want to discuss is dividend. Dividend plan. So we have three plans. One is called growth plan, where no dividend, no bonus, no dividend and no bonus. So first type of plan I have is a mutual fund. I have types of plans. First plan is growth plan. Here, no dividend, no bonus. Useful. This is useful for people like us. If you are in a working age, you will invest in a growth plan because you don't need any income now. You don't need any income now. You would want the NAV to keep going up. It should not fall down to 49 or 50. It should keep going up. It should keep going up because I don't need any money now because I'm getting my salary income. I'm getting my salary income. I don't need any money at this point of time. So first is no dividend, no bonus, technically called growth plan. Useful regular income is not needed. If I don't need any regular income, I'll go through which plan? Growth plan. The second type of a plan is bonus plan. Extra units are allotted. Extra units are allotted. In a bonus plan, they're going to use allot what? Extra units. But what will happen because of extra units is NAV will fall. NAV will fall. And then NAV will start again going up because of market. Suddenly again you declare bonus, NAV will go down, again go up, go down, go up, it will keep happening. But NAV will go down moment the bonus is declared. Moment the bonus is declared. The third type of a plan is dividend plan. This is what we are going to see in a problem solving. In the dividend plan, the plan is called payout. Dividend plan, payout is very simple. Dividend is credited to the bank account of unit holder. Dividend is credited to the bank account of the unit holder. I declare dividend, you get the dividend, you can do whatever you want to do. You can do whatever you want to do with that money. You want to spend on some purpose, you want to do shopping, whatever be your purpose. That's called dividend payout. Dividend payout means I will give you money, you do whatever you want to do with that money. Practically now taxation angle and all comes into picture, but whatever it is, I'll give you the money, you can do whatever you want to do with the dividend plan payout. Whatever formula I gave till now, NAV1, NAV0, D1, CG1 was technically for a payout plan, was technically for a payout plan, because I will give you the dividend, I'll give you the dividend. There's another type called dividend reinvestment plan. There's another type called dividend reinvestment plan. I have one payout plan. I also have another plan called what? Reinvestment plan. Reinvestment plan. Now, what happens in a reinvestment plan is I will give dividend. It is assumed. It is assumed is that it has gone to your bank account. It is assumed that it has gone to your bank account. It is also assumed that you return back that money to me. You return back that money to me. So what happens here is mutual fund declares 1,000 rupees dividend for you. It goes to your bank account, which will not happen in the practical world. You return back to the mutual fund, and mutual fund will say 1,000 divided by 12, 13, 14, 15, whatever is the NAV, and give you extra units. Give you extra units. It will divide by 12 rupees, 13 rupees, 14 rupees, 15 rupees, whatever be the NAV, whatever be the NAV, I'll divide by that NAV. So we will calculate first dividend in rupees. Then I'll say dividend in units, dividend in rupees, and then I'll say dividend in units, dividend in units. In a payout also, I could have done this. How I could have done this? The money came to my bank account. Immediately I send back to the mutual fund. Immediately I send back to the mutual fund. When I send it back to the mutual fund, they would have given me extra units. They would have given me extra. See, payout basically means you can do anything with that dividend. You can do anything with the dividend. Reinvestment means that dividend will only become new MF units. The dividend will only become new MF units. New MF units. Practically, again, reinvestment is not there, because if I want to do reinvestment, let me do growth plan itself. Let me do growth plan. It is there, but practically people don't use it, because if reinvestment option is there, I don't need money. See, reinvestment means I don't need money. If I'm not in need of money, let it be a growth plan itself. No, let it continue to be a growth plan, because growth plan, what happens? No dividend, no NAV fall, no impact. So 10,000 units remain same. Here units will go up in reinvestment. NAV will go down. NAV will go down. In the end, both are same. In the end, technically both are going to be same. Only extra angle now is income tax. Income tax has now played some part. So somewhere some scheme can be better depending on your tax rates. Depending on your tax rates, for few people growth could be better. For few people reinvestment. But practical flavor, reinvestment is not preferred by people. Reinvestment is not preferred by people, because as well I can as well go for a growth plan. To cut it short, there are three types of plan. Growth plan, no dividend, no bonus, useful if regular income is not needed. You can use the formula of NAV1 minus NAV0, that's all. Whole divide by NAV0 into 12 by M into 100. Bonus plan, extra units are allotted. Extra units are allotted. That formula will not work. NAV1 minus NAV0 formula will not work. Then what formula will work? The formula is what I get back minus what I invest. What I get back, you have to calculate overall value. What I invest, you have to calculate overall value. Divide by what I invest, overall value. The formula will be what I get back minus what I invest, divide by what I invest, but per unit calculation not possible. Per unit, because when I invest in a growth plan, I start with 100 units, I end with 100 units. So 1 unit calculation you can do. Bonus plan, you start with 100 but end with 500. Dividend payout, you start with 100, end with 100. Formula can be done. Formula can be done. Reinvestment, again that formula will not work. Reinvestment, again the formula will not work. Then what formula I'll use? What I get back minus what I invest divided by what I invest into 12 by M into 100. So in this case, dividend is converted into units. Dividend is converted into units, and we reinvest the money. We reinvest the money. Dividend is converted into units and we reinvest the money. Clear? Any doubts on this? Close. I may have to check, but I don't think so. Close-ended gets into all this. Close-ended, there is a fixed number of units. That's all. Close-ended has a fixed number of units, but I haven't even thought about it. So I'll check and then get back to you. So there are three types of plan: growth plan, bonus plan, dividend payout, and dividend reinvestment. Dividend, it's only dividend plan, but it is called payout and it is called reinvestment. All the four same formula you can, which is what I get back minus what I invest divided by what I invest. But some, for simplicity, you can do per unit calculation. For few plans, you cannot do per unit calculation. You cannot do per unit. See, if I have to do per unit calculation, 100 opening units should become 100 closing units. If that is there, per unit calculation is possible. Because otherwise, what will happen in bonus plan is starting NAV 10, ending NAV will be 10 only. Ending NAV will be 10 only. But still, you would have earned a huge return because initially you had 5,000 units. In the end, you had 50,000 units, which means 10x return. It would have become 10 times return. So formula can be used only when the units are not going to change. Formula can be used only when the units are not going to change. If the units are changing, then the formula is what I said earlier: what I get back minus what I invest divided by what I invest into 12 by m if you do annual return. If you don't do 12 by m, it is holding period return. It is called holding period return into 100 into 100. Any doubts on this first? Any doubts on the concept? Sorry, is this mutual fund dividend? The stock can keep, you see, a mutual fund invest in so many companies. So this mutual fund, when it invests in so many companies, will keep getting dividend income. Whatever income they generate, a part of it, if they want to declare, it is called dividend distribution. If they want to declare, that all depends on if they want to declare. It can be called as dividend distribution. It can also be called as capital gain distribution. Capital gain can also be reinvested. Dividend can also be reinvested. Link them separately. See, there are mutual fund like debt mutual fund. What do debt mutual fund do is they invest in RBI bonds. They invest in corporate company. These mutual fund will also be declaring dividend. They don't declare interest. Debt mutual fund does not declare interest. Debt mutual fund is going to declare dividend. Is going to declare dividend. From where are they declaring dividend? They are declaring dividend from the interest income they generate. From the interest income they generate. So no linkage. Company is different, mutual fund is different. Don't try to link it together. Company, we will do separate analysis in security valuation chapter. MF, whatever investments it is making, it will earn returns out of it. Whatever returns it's generating, from that return, it will either declare dividend or declare capital gain distribution or do none of them. So I have technically three types of plan: growth plan, no dividend, no extra units; bonus plan, extra units are allotted; payout, units given in rupees to you; reinvestment, sorry, dividend given in rupees to you; reinvestment, dividend given in the form of mutual fund units. Dividend given in the form of mutual fund units. Any doubts on this? Any doubts on this part? Clear? Can we proceed? Dividend payout versus dividend reinvestment. In a dividend payout plan, the investor will get dividend in rupees. The dividend will get in rupees. And in case of dividend reinvestment, dividend will get reinvested and we will get what? Additional units. We'll get additional units. What is the units you'll get? Dividend amount divided by reinvestment NAV. Divided by reinvestment NAV. Return for payout would be computed as per the above formula. Above formula means whatever you learnt earlier. Dividend reinvestment. Dividend reinvestment is closing value. Closing value is what I get back. Opening value, what I give divided by what I give, into 100 holding period into 12 by m, Clear? Any doubts on this? That note I'll discuss as we proceed. Any doubts on this? So I have two types of plan. Payout plan is there, reinvestment plan is there. Payout plan is there and reinvestment plan is there. In a payout plan, you will get dividend in your bank account. You can use per unit formula. In a reinvestment plan, it will not come to your bank account. So you have to do overall analysis. You'll have to do overall analysis. Clear? Any doubts on this? It's a frequently tested exam question, or is added in MTP, RTP. Question 5 has got added in many RTPs, MTPs. It's a very simple question only. Let's go through 5 now. Mr. X, an investor, purchased 300 units of ABC mutual fund. Question 5, page 205. 300 units of ABC mutual fund at the rate of 12.25 per unit 1 year ago. Moment it's 1 year ago, holding period return and annual return will be same. Over the year, X received 1.25 as dividend, capital gain of 1 rupee. You are required to calculate holding period return. Holding period return means no 12 by M to be done, but anyway doesn't really matter, it's the same. Assuming that no load fund. What is no load fund? As we proceed, you will learn about something called as entry load. And lot of pointers I can keep telling you only as we proceed, because I don't want to add up all the concepts. Later chapters you will say we would have learnt it earlier, so you have to be very clear, because today I teach a concept. I may discuss this after 30 classes. I don't know when will I discuss. Only thing is, that is where that concept book is given. Today if you have just read that concept 1, concept 2, I don't even expect you to practice question unless I give you homework. But concept book reading is compulsory. 5 minutes before the class also you do, it is sufficient. Or you spend some time at home, soft copy is given. Before sleep you can just, instead of browsing your Insta and other things, you can see my material. Tough, but still see my material for 10 minutes. Concept book, if you see it, just keep revising the concept again and again. See, I am familiar with the concept because I am keeping on reading that. I have read it maybe some 100 times by now. Keep reading it, it's not going to take much time. I don't even want you to solve the example, but just reading it multiple times. As you become familiar with the concept, things will become easier. Otherwise you will say so many concepts are added onto it, it will become difficult for you. So here, no load fund has a NAV of 13. I put a stop here. Please calculate the answer. NAV 1 minus NAV 0, D1, CG1. Part 1, apply normal formula. Killer person. Sir, இங்க இல்ல. Just a minute. Keep doing it, I'll be back. So part 1, thing you should have done, very simple calculation. 13 minus 12.25 plus 1.25 plus 1 plus 1 whole divided by 12.25 into 100. Doesn't really matter whether it's 300 units, 1000 units, 1500 units. I just told you to do per unit calculation. 24.49%. 24.49%. Nothing was added onto the question. Whatever I told something like payout, bonus, nothing was there in the question. Like the previous question, part A. Part A is like the previous question. So I have told you to use the formula. We are done with it. Any doubts on this? Next, Mr. X holding period return, assuming all the dividend and capital gain, all the dividend and capital gain is reinvested into additional units, at an average price of 12.50 per unit, at an average price of 12.50 per unit. That is, first I will do what I invested, then I'll calculate dividend in rupees. Dividend in units is dividend in rupees divided by 12.5, divided by 12.5. So my 300 could have become 400, 450. I don't know the number. We'll have to do the calculation. Will I get the dividend income? No, that's not my income. What is the benefit? Day 1, 300 into 12.25. Last day, 400 or 350 or 450 into 13. The more units you get, more units. So your income is in the form of extra units and not in the form of exact money given in bank account. I don't give the money in bank account, but still the income is there. It's not that income is not there. You are getting the income. Earlier, your investment is 300 into 12.25. Maturity value could be 400, 500. We don't know. We have to do that calculation. 300 into 12.25 is what I get back. Sorry, what I give. What I get back is 400, 450, 350. I have to do that number into 13. Into 13. Clear? Any doubts on this? Let's start. Return for dividend reinvestment plan. Return for dividend reinvestment plan. Just for your understanding, write this. Return is what I exam will not write it like this. I'm just trying to explain in a way it is easy for you to understand. Obviously, in exam, I don't want you to write this way. What I get back minus what I invest divided by what I invest into 100. Our objective would be to not use any formula anywhere. So I'll try to keep it without formula to the extent possible. But some places I can't help it. But otherwise, understand the crux, then automatically the formula will come. Now, particulars calculation amount. Particulars calculation amount. Amount invested. Amount invested. Now, how many units and all will matter here? Amount invested. How many units did we invest? At what rate? 12.25. 3675. Clear? Dividend and CG per unit. Again, I'm repeating, for me, there's nothing like capital gain. For me, everything is dividend. For me, everything is dividend. Dividend and capital gain per unit. All put together how much? 1 rupee 25 paise and 1 rupee all put together 2.25 per unit. Total dividend. Total dividend bracket in rupees. 300 into 2.25. 300 into 2.25. See, this calculation I could have done even for the earlier option also. We wrote D1 at a per unit level. Instead of writing per unit, I could have written 675 also. Everything would have been multiplied with 300, which would have taken more time. We were not bothered because number of units were to remain same. Total dividend in rupees 675. Any doubts on this number? 675. Then dividend in units. Dividend in units. Now, what is dividend in units is this 675. The 675 is going to be reinvested. Is going to be reinvested at some rate. What is the rate given? Reinvestment 12.5. Dividend in units 675 divided by 12.5. I'll get 54 units. To cut it short, 300 will become 354 and 12.25 has become 13 rupees. 12.25 has become 13 rupees and 300 has become 354. 300 has become 354 and 12.25 has become 13 rupees. So both put together, I'll generate my return. Listen, in this example, indirectly, dividend income you got, no? Reinvested at what rate? 12.5. Closing it is at what rate? 13. So indirectly on income you're generating further income. On income you're generating, it's like interest on interest. We have compound interest. On interest I earn extra interest. So on this dividend I earn extra money. How am I earning extra money? Because by the end, this 12.5 became 13. 12.5 became 13 because they are saying closing NAV is how much? 13 rupees. Today I gave you 675 rupees, which is 54. By the last day, this 54 is 702 rupees. 54 is 702 rupees into 13 into 13. So indirectly in this question, I'm earning income on income. I'm earning income on income because I gave you dividend reinvestment happened at 12.5. I gave you 54 units. I gave you 54 units. By the time year got over, by the time year got over, I don't know when reinvestment happened and all. By the time year got over, 12.25 had become 12.5, and by the year end it has become 13. By the year it has become 13. Closing value 354. 354 into 13 rupees. So very simple. I gave 3675. You are giving me back 4602. This is the only math I understand. I don't want to know dividend. I don't want to know capital gain. I don't want to know reinvestment. Only thing I understand is from my bank account 3675 went. From the mutual fund account, I get 4602. Apart from this, I don't understand anything else. My logic is very simple. I gave 3675. You are giving me back 4602. Gap is my return. The gap is my return. Next line, return in rupees. Return in rupees. 4602 minus 3675. 927 rupees. And then we'll do percentage. Percentage means you have to divide by the investment amount. You have to divide by the investment amount. Again, I'm repeating. If you try to remember formula and do AFM, you will struggle at many places. There are places where I'll tell you to remember the formula. I will tell you that place. But other places, if you do logically, you will understand the flow of transaction. You can link it with practical world. Some parts of it I'll try to show it. But also you also do reading on your own. Any doubts on return in rupees? Then return in percentage. 927 927 divided by 3675. 25.22. Any doubts on this? This was the earlier method answer. 24.49. I anyway knew that it is going to be more. Reason is very simple. You earned income on income. You earned income on income. That 12.5 became 13. Sometimes the 12.5 by the end can become 12. Then on your income, you have earned negative income, which means your return will go down. Return will go down. We have earned here what? Income on income. We have earned income on income. The 12.5 which we reinvested became by the end as 13 rupees. At the end it became 13 rupees. In the same question, if my reinvestment was, let's assume, at 13 rupees 50 paise, then my final return would have been lesser than 24.49. Lesser than 24.49. Logic is very simple. If you reinvested 13.5, first you will get lesser units. You will get lesser units. For example, in the above calculation, if I do 13.5, if I do 13.5, get 50 units. I get 50 units. 50 into 13 rupees into 13 rupees, 875, and my return is 23.81%. My return is 23.81%. I'll explain the logic again. In this example, whatever reinvestment I did, I am very happy because on that reinvestment also I made more money. On the reinvestment also I made more money. How did I make more money on the reinvestment? Because of that extra portion. 12.5 became 13. Reinvestment could have happened at 13.5. Could have happened at 13.5. If it had happened at 13.5, I'm unhappy about it because 13.5 unfortunately by the year end became what? 13. So whenever reinvestment happens, I'll be very happy. I'll be very happy if it happens at a lower rate. If it happens at a lower rate. Clear? Any doubts on this? Any doubts on this? Last part of the question. What difference would it make in terms of returns available, we have already calculated. Which option is preferable? In this example, dividend reinvestment is preferred. In this example, reinvestment is preferred. Some other example, payout could be preferred. Some other example, payout could be preferred. Here, 24.49, 25.22, it can be said that reinvestment option is better. Reinvestment option is better. Some other problem when I do, payout could be better. Frequently added question in MTP, RTP. That is why I've added this as a concept revision. I've added this as a concept revision question. Even I think this also, without even doing that, if you do this example also, it is sufficient. This example also could have taken care of it, but still, because it was tested so many times, I made it as concept revision there. What does concept revision mean is, whenever you do your revision stage, you will pay more attention to those questions. You will pay more attention. See, purpose is, I'm not trying to say that same question will get repeated in exam. What I'm trying to say is, I want you to cover all concept. So suddenly a question comes from whatever concept I discussed in concept book, you should be able to handle it. Some question I need more practice. Those question alone I mark it as concept revision. Any doubts till this? Any doubts on this? Can we proceed? So we have come across one important area called dividend payout plan versus dividend reinvestment plan. In a payout plan, I give you dividend in rupees. See, question said we earned a return of how much? Here 24.49. But what we are missing out here is that 675 I gave, no, you could have put it at some other place and earned extra 100, 200, 300, 50, 60. I don't know what you did with that. I don't know what you did with it because of lack of info. I cannot analyze it. But practically what can happen is, to cut it short, these two are not comparable. These two are not comparable. So question will say which is better. Why it is not comparable? I gave you money, 675 rupees. What did you do? You created a fixed deposit. That 675 could have given you an interest income of 10 rupees, 15 rupees, 5 rupees. I don't know. I am not getting into that analysis, but you could have done anything with that 675. In other simple words, these two ideally cannot be compared, but exam question will ask you which is better, whichever gives higher return, whichever gives higher return. Clear? Any doubts on this? Any doubts on this part? Done? Okay, I'll take a 10 minutes break and then we resume. Okay, let's proceed. I'll just summarize what we did till now. We learned that there is a payout plan and a reinvestment plan. For calculating return, I have a formula which says NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M or without 12 by M. And in case the units are changing, then the formula is what I get back minus what I give divided by what I give into 100. Clear? Any doubts on this? Any doubts on this part? Okay, we are going to do a comprehensive question, a lengthy one, can take maybe around an hour for us. Let's come to question 7, a comprehensive and a lengthy problem. Sunmoon Mutual Fund sponsored open-ended equity-oriented scheme, Chanakya Opportunity Fund. 3 plans, dividend reinvestment. Any question on dividend reinvestment will take away a lot of time. Because I have to do reinvestment calculation. You'll understand when I do it. Bonus plan and growth plan. Growth is the easiest to do because no changes in units. At the time of IPO, like it is not IPO, it should be called NFO, new fund offer. New fund offer. For a share, we call it as IPO, initial public offer. For a mutual fund, the name is called new fund offer. At the time of NFO, on 1499, Mr. Anand, Mr. Bachchan and Mrs. Charu invested and chosen B, C and A. That is, the first investor has chosen bonus plan. Second investor, Mr. Bachchan, has done growth plan, and the last person has gone for a dividend reinvestment plan. Date, dividend percentage, bonus ratio, face value is rupees 10. Now the use of face value is, if you see when you do your shares, dividend, if they say 20%, it is 20% of face value. It is 20% of face value. Same logic for MF also. If it is a percentage, it's a percentage of what? Face value. It is a percentage of the dividend rate. There's something called as dividend yield. I'll keep proceeding as I go forward. Dividend rate is applied on face value. Dividend rate is applied on face value. This is the note which I said I'll explain later. Dividend rate is to be applied on face value of units, on face value of units to calculate dividend earned by the investor. This will also help in computing the number of units reinvested, in dividend reinvestment plan, for calculating the reinvested units. For calculating the reinvested units, I'll need the dividend. Now, in this question, lot of transactions have happened starting from 28 7, 31 3, 31 10, 15 3, 31 3, 24 3, and 31 7. 5 dividends have been declared and 3 bonus have been declared in this. 5 dividend and 3 bonus, and they have given NAV for what is the plan A? Plan A is what? Can you just see and tell me? I'll write it here. Okay, this is dividend reinvestment. Plan B, bonus. Plan C, growth. So these are the NAV for the 3-1. First one is dividend reinvestment. So whatever reinvestment happens will happen at this NAV in this column. Bonus NAV is of no use. Only last NAV I want. But the units will keep doubling, tripling, going up. Growth, nothing matters. Only the last. On 31st July, all 3 investors redeemed all balance units. Calculate annual rate of return. For doing annual rate of return, I'll do 12 by M. When is the starting date of investment? 1499. We are redeeming on 31/7/2009. Can you tell me how many years and how many months? 1499 and 31/7/2009. 10 years and 4 months. Don't make a mistake. 10 years and 4 months. 1/4 April, May, June, July. So technically 124 months. So in the calculation, we'll do 12 by 124. We'll do 12 by 124 when I do return calculation. The investment has happened for 10 years and 4 months. Long-term capital gain is exempt from income tax. Short-term capital gain is subject to 10% income tax. Any units allotted in the last 1 year, will have STCG, will have short-term capital gain. So when I say what I get back, I'll subtract income tax. They have said LTCG is exempt. Now, if same question comes now, LTCG also will be taxable. STCG will also be taxable. Calculation can become, see, I'll explain one calculation. Once you understand one STCG calculation, same has to be done for LTCG or STCG. LTCG exempt makes it easier. If LTCG was also taxable, then you have to do a lot of calculation. You will understand when I proceed. Securities transaction tax is 0.2% on sale or redemption. So in what I get back, first thing I'll subtract is securities transaction tax. Ignore education cess. Before I solve something from an income tax point of view, nothing to do with FM, but cost of acquisition of bonus units will be taken as 0. That is when you calculate capital gain. For bonus units, your cost of acquisition will be taken as 0. Cost of acquisition. When I checked with the tax faculty, there is some cutoff date and then it changes. But for problem solving, cost of acquisition for bonus units will be taken as 0. ICI has said alternatively, they have given 2 answers. One is taking it as 0 and second is taking at the NAV on the date of bonus allotment. But for our purpose, cost of acquisition of bonus units will be taken as 0. Securities transaction tax is not allowed as a tax deductible expense. This is as per your income tax, nothing to do with AFM, while computing what? LTCG and STCG. So this is just an income tax angle which I've just added it here. Reason of adding it here is very simple. When I just revise this, I'm kind of clear, or as to what needs to be done. Kind of clear as to what needs to be done. Clear? Any doubts in this? Which is for everything. STTs are not tax deductible for bonus, for growth plan, for payout plan, for reinvestment plan. Securities transaction tax, I think when you do your capital gain calculation, you cannot subtract it as a tax deductible item. This is what I learned from a tax faculty when I was, see, in case there are changes in taxation, I am not the right person. So in case there are changes, you will have to update me. I have just followed whatever is there in ICI SM for the question solving. I am not a tax expert, so we will not get into that. And ideally, exam question should not test all this. Our exam question can only tell us that what is tax rate, all that they can tell. But TK, because questions will come around this, 2 points only you have to remember. Cost of acquisition of bonus units will be 0, and securities transaction tax is not allowed as a tax deductible expense. Tax deductible expense when you calculate what? Long term capital gain, short term. In this question, I'm not going to calculate long term capital gain because it is exempt. Why should I break my head and calculate that? So we are not going to calculate LTCG, but we have to calculate STCG. We have to calculate STCG. On the STCG part, when you calculate taxable STCG, sale value minus cost of acquisition, no STT subtraction. No STT subtraction. That's the only point I want to say here. Clear? Can we start now solving the question? Any doubts on this? Now, I'll first do dividend reinvestment, which is what is going to take us a lot of time. Dividend reinvestment, that is what is going to take us time. So we'll first calculate dividend reinvestment. In dividend reinvestment, I started with 1 lakh rupees divided by 10. 1 lakh. NFO will be at face value. NFO will be at face value. If it's not NFO and in between, then NAV can keep changing. See, when you buy it for the first time it will happen at face value. It will happen at face value. Second time purchase can be at 30.7, 58.42, 42.18, 46.45, 48.10. It can keep happening at different prices. First purchase will be at on new fund offer, on the new fund offer. Suddenly some students message me in the past batches. Next question when you do, you will see that two schemes investment has happened, and here they said when the investment happened, NAV was this. NAV was this. So my initial units was divided by the initial NAV given in the question. Initial units was divided by the initial NAV given in the question. I was a little surprised why doubts are coming. Then only I understood that when I did 7, I said divide by 10, and when you will do 8 at home, it will not be divided by 10. It will not be divided by 10 to calculate the initial units. To calculate the initial units. Initial units in NFO, in new fund offer. Initial units in new fund offer. In new fund offer will come at face value. In new fund offer will come at face value. If it's not a new fund offer, if it is not a new fund offer, it will happen at whatever NAV is there. Whatever NAV is there. In to cut it short, in new fund offer, NAV is 10 rupees. It's not face value. NAV is 10 rupees. Allotment will happen only at NAV. Allotment will happen only at NAV. In the new fund offer, face value is equal to NAV. If it's not a new fund offer, the face value and the NAV will obviously be different. The face value and NAV will obviously be different. Clear? Any doubts on this? Any doubts on this? So let's working note 1. Who has invested in dividend reinvestment? Which person? Can you just see the question and tell me? Computation of return of Miss Charu. Return of Miss Charu in bracket dividend reinvestment plan. Return of Miss Charu dividend reinvestment plan. Dividend reinvestment plan. Note 1. Computation of units on maturity. Computation of units on maturity. I may need 5-6 columns. I don't know the number of columns, so you manage space accordingly. First column is date. Second is dividend percentage. We may need Not sure. 6 7 5 6 columns. So you manage space accordingly. Date, dividend, percentage, opening units, opening units, dividend in rupees, dividend in rupees. I'll explain once I'm done. Reinvestment NAV, reinvestment NAV, dividend in units, closing units. I'll explain this when I do one reinvestment. There you'll understand. Date, dividend percentage, opening units, dividend in rupees, reinvestment NAV, dividend in units, and closing units. The computation part you will understand. When is the first day dividend has been declared? When is the first dividend declaration? Right, 28/7/2003. 28/7/2003. 28/7/2003. The first dividend is declared. Once you understand one calculation, two calculation, balance is formality. What is the dividend percentage? 20%. When when I'm on this date, I have in my hand 10,000 units. What is 10,000? 1 lakh divided by 10. 1 lakh divided by 10. I have 10,000 units in hand on 28/7/2003. On 28/7/2003, I have 10,000 units in hand. Dividend in rupees is 10,000 into face value into 20%. Dividend is declared on face value. 10,000 units into face value into 20%. 10,000 units into face value into 20%. Very important calculation. If there are doubts, you can tell me. 10,000 units into in rupees face value into 20 percentage. 20,000 rupees. Clear? On this day, there is an NAV given for dividend reinvestment plan. NAV for dividend reinvestment plan. Look at the table and tell me the NAV for dividend reinvestment plan. 30.7. 30.7. Dividend, the first column is dividend reinvestment, second column is bonus, third column is growth. So my reinvestment happens at 30.7. This is technically column 4 divided by column 5. This I am going to get extra units now. I'm going to get extra units now. This 20,000 rupees will get reinvested at the rate of 30.70. Will get reinvested at the rate of 30.70. Will get reinvested at the rate of 30.70. Any doubts on this? 20,000 rupees is the dividend. 20,000 rupees is the dividend. Mutual fund is saying, I'll give you 20,000. You are saying, I am giving you back 20,000. I am giving you back 20,000. Mutual fund says, okay, I will give you 20,000 divided by 30.7. We'll work with 2 decimal because the NAV is given 2 decimal. Units also 2 decimal. Units also 2 decimal. I get 651 units. Get 651 extra units. So originally 10,000 was there. Extra 651.47. Extra 651.47. My closing units is 10,000 plus 651.47. Any doubts on this? Clear? Can you proceed? Then comes the next dividend date. Next dividend date, whatever is the next dividend date. When is the next dividend declared? 31/3/2004. How much? Now my units are 10,651.47. Units are 10,651.47. 10,651.47. Dividend in rupees is 10,651 into 10 rupees into 10 rupees into 70% into 70%, which is some 74,560.29. 74,560.29. Any doubts on this? Again, I tell MF, you don't give me 74,000 rupees. I give you back the 74,000 and you give me extra units. You give me extra units. What is the reinvestment NAV on this date? Because there's a huge NAV, but ठीक है, 58.4 will be allotted extra 1276.28. We allotted 1276.28. 74,560 divided by 58.42 divided by 58.42. You can keep repeating the cycle. Refer the screen in case you have a doubt. You have to repeat for three more items. Three more items. There are three more dividend declared. Three more dividend is declared. Refer the screen in case you have a doubt. Otherwise, keep doing it. Otherwise, keep doing it. Practice it in the class itself. Keep doing it. I am writing it here. You have a doubt, let me know. Keep doing it. Keep doing this. Let me know in case there is a doubt in any of the computation. The closing units is 14,906.16. It's a calculation heavy area, but once you understand one calculation, everything is just a formality. Complete it. Let me know if there are doubts. So this calculation I wanted you to do. Now, before I do the return calculation, I'll check on capital gain part. If it was LTCG taxable, for 10,000 units, you have to calculate capital gain. For 651 units, you have to calculate capital gain. For 1276 units, you have to calculate capital gain. For 1131 units, you have to calculate capital gain. 702 units, you'll have to calculate capital gain. For 1144 units, you have to calculate capital gain. What will be the cost of acquisition? This is technically the cost of acquisition. This is technically the cost of acquisition because you have paid that money. You have paid that money to get the units. Selling price is given in the end. So every allotment you have to calculate capital gain if it LTCG was taxable. If LTCG was taxable, capital gain calculation is simple, but every allotment I have to calculate capital gain. Now, as far as STCG is concerned, we are selling it on 31st July. 31st July, any units allotted between 1st August 2008 till 31st July, 1st August, 1 year. Within a 1 year period will come under the short term capital gain, will come under the short term capital gain 1 year period, which is only this 31 24/3, which is only 24/3, because 31/3 2008, 31/3 2008, sorry, 31/3 is not there, 15/3 15/3 2008 is more than a year. 15/3 2008 is more than a year. We are closing it out. We are closing it out on 31/7 2009. We are closing it out 31/7 2009. Any units allotted in the last 1 year, allotted in the last 1 year will be taxable as short term capital gain, for which the selling price is 53.75, cost price is 48.1, cost price is 48.1. In case LTCG was taxable, 53.75 minus 46.45, one capital gain. 53.75 minus 42.18, another capital gain. 53.75 minus 58.42, capital loss. 53.75 minus 30.7, capital gain. So you will have to do multiple capital gain calculation. I just hope they don't get into that amount of testing, because it doesn't make any difference. Because my job here is not to get into taxation angle. My job is here to understand finance. So in finance, I don't want to get into this discussion. Okay, practical world, this is the calculation we're going to do. So we are going to calculate note to capital gain, note to capital gain and tax on capital gain. Note to capital gain for units allotted within 1 year, STCG. Capital gain for units allotted within 1 year, STCG. Short term capital gain is equal to 1144.43 into, that is the units allotted, 1144.43 units. 1144.43 units. That is the unit allotted on 24/3/2009. 24/3/2009 into selling price minus cost price. STT and all, no deduction. Selling price minus cost price. 1144.43 units into selling price minus cost price. On 31st July when I sell, my selling price given in the question for plan A is 53.75. 53.75. My selling price is 53.75 and my purchase price is reinvestment rate. Purchase prices. When I do bonus, the purchase price is 0. For bonus, the purchase price is 0. For bonus, the purchase price is 0. For reinvestment, this is see. Practically what will happen is when you reinvest, no, the dividend income, no, on that income tax will tell you to pay tax. You will have to pay tax on the dividend income, whether you reinvest, not reinvest, that's your headache. But on that income, you have to pay tax as per your income tax provision, whatever. There can also be TDS deduction and all by the mutual fund. But on the dividend, you have to pay income tax. You have to pay income tax. Whether you're reinvesting, not reinvesting, it's not our worry. Ideally, I just hope they don't get into testing all that, because that will complicate the calculation. It's just going to take more time on the calculation. Selling prices 53.75, cost prices 48.1. Tell me the amount of capital gain. You can round off and tell me the final number. 6,466. Okay, 6466. 6466. I can round off and write amount wouldn't make a big difference here. 6466 is the capital gain. Now this I did only one. If LTCG was taxable like this, you have to do 5 calculation. This one, another 4, and the first one, and the first one. 10,000 units one calculation, extra 651 units second calculation, 1276 units third calculation, 1131. Would the calculation be different? No, nothing different. No indexation, nothing is going to be different. You just need to put the same formula. You just need to put the same formula, selling price minus the cost price. Tax on STCG. Tax on STCG. What is the tax rate given? 10% into 6466. 647 rupees I'll deduct from what I get back. 647 rupees I will deduct in what I get back. 647 rupees is the tax on short term capital gain. Any doubts on this? We did only one calculation. I could have increased this to at least 5 more calculation in case LTCG was taxable. In case LTCG was taxable, I wouldn't want such a question to come unnecessarily because waste of time. It is waste of time. You're not going to learn anything. Core concept of finance is not tested, but ICI can test because anyway you are learning taxation, you are learning AFM. So together they can end up asking a question. Any doubts till this? Next, note 3. Annual return calculation. Annual return calculation. Particulars calculation amount. Particulars calculation amount. Particulars calculation amount. Sale value on maturity. Sale value on maturity. I invested 10,000, but I'll be selling now 14,906. 14,906.16. 14. See, this is the exact same thing I did in earlier dividend reinvestment. If you see here, this is the exact calculation we did here. Closing value. Closing value 354 into 13. But there, no capital gain, no STT, all that headache was not there. So I just directly did the calculation and closed it, and only one reinvestment was there. Only one reinvestment was there. Here, I have so many reinvestment. I have so many reinvestment. So 14,906.16 into 53.75. Again, we'll round off and write. I'm not going to bring decimals here. The amount, because it is a huge number, decimal may not matter. 801,206. 801,206. And this is what practically MF does. Okay, I invested 1 lakh. I'm going to get back 8 lakh rupees. I'm going to get 8 lakh rupees, which is a huge return, which is going to be technically a huge return. But it's happening over a period of 10 years. But think still 8 times it is happening. It is going to be a decent amount of return. Sale value on maturity is 801,206 less securities transaction tax at the rate of, some rate is given in the question, 0.2%. 801,206 into 0.2%. Some 1,600 rupees. Securities transaction tax at 0.2%. What else should I subtract? One more item I have to subtract. STCG tax. STCG tax. $647. STCG tax 647. Net amount realized. Technically, what I get back. Technically, this is what I get back. Net amount realized. 798,957. Net amount realized 798,957. Net amount realized 798,957. What I get back minus what I invest. What I invested is 1 lakh. What I invested is 1 lakh will give me return in rupees. If you divide by 1 lakh, return in percentage. If you do into 12 by M, annual return. If you do 12 by M, it is annual return. Clear? Any doubts on this? Less amount invested. Less amount invested. Amount invested. Amount invested. Return in rupees. Return in rupees 6 lakh 98. Return in rupees 698. Clear? I'm earning 6 lakh 98,000 on a base of 1 lakh. On a base of 1 lakh rupee, which is technically 698 percentage will come, but that is holding period. I have to do annual return. I'll have to do annual return. For annual return, I said 124 months. It is 124 months. We started investment 10 years and 4 months. 10 years and 4 months. Annualized return. Annualized return bracket percentage 698 divided by 1 lakh into 698 divided by 1 lakh into 12 by 124. 12 by 124. 12 by 124. 698 divided by 1 lakh. If you just divide by 1 lakh, it is called holding period return. That's called holding period return. That's called holding period return. And if you do into 12 by 124 into 12 by 124 into 100, 67 point 67.64 percentage is the annualized return I'm generating. 67.64 percentage is the annualized return I'm generating. Technically, again, I'm repeating, this ignores a very important item called time value of money. It is ignoring an extremely important item called time value of money. But still, 67.64 percentage. Any doubts in this? Any doubts in this part? Can we proceed? Hmm. Okay, so then in the numerator also I'll have to add the value now. The point is that that is not out of my pocket. I gave you dividend, you gave me back, you gave me back. So from your pocket you have paid only 1 lakh rupee. From your pocket you have paid only 1 lakh rupee. You did not pay any extra amount. The mutual fund declared dividend, you sent it back to the mutual fund. You sent it back to the mutual fund. So technically from my side, I invest only 1 lakh rupee. My investment is only 1 lakh rupee. Tell me, you are still confused. So that is why I said this, whatever I've calculated annualized return, that's not the right way of calculating return. There's something called as an IRR approach where whatever you're going to say will get adjusted. That will get adjusted because under IRR approach, I'll have to see timeline of returns and then calculate it. I'll have to see timeline of returns and then, but to put it simply, this is right as such because I invested only 1 lakh. I did not invest any of the amounts in between. I did not invest any of the amounts in between. See, you are my client. You don't understand dividend reinvestment, dividend payout. You have invested money. 1 lakh, you put it on the day one. In between, something is happening. Suddenly, some units are going up, units are going down. You are least bothered about all of this. You don't even understand what has happened there. From your side, you know only one thing. I paid 1 lakh. I got back 7 lakh 98 957. My return is 698 957, which is 698 percentage, which is 698 percentage, and I'll do into 12 by 124 into 12. The whatever reinvestment is happening, you can notionally say that I'm investing that money, but technically still it is not a money which is going from your bank account, not going from your bank account. So technically it will not form part of investment. Any doubts on this? Any doubts on this part? Later on, I'll add a variant called IRR approach, which in fact surprisingly came in one of the exam or MTP some two attempts back. It came in one MTP or an exam. I'll discuss it as we proceed. Any doubts on this? 67.64%. Clear? So this is what we have done as of now. This is the dividend reinvestment plan. Date, units held is opening units. The format could be slightly different. Dividend percentage, amount. Amount is units into face value into dividend percentage. Reinvestment, NAV. New units is D is equal to B by C, which is your dividend amount divided by the reinvestment NAV, and you get the closing units. You get the closing units. I slightly altered the format. I don't remember the format and all. Why I have given this format? So that when you do your revision, you're able to see this, and this is kind of taken care. This is kind of taken care. What I did in the question, I think I swapped the column 2, column 3, whatever, it doesn't really matter. Date, opening units, dividend in percentage, dividend in rupees, reinvestment NAV, extra units allotted, and closing units. Extra units allotted and closing units. Any doubts on this? Any doubts on this? So we are done with reinvestment plan. If I want to complicate the question, I'll say LTCG taxable. I'll say LTCG taxable. Want to further complicate it, then I'll say you have to pay income tax on dividend. You have to pay income tax on the dividend part. So it can be complicated the way I want, but I don't see ICI getting into that. That's more of a tax flavor rather than this. Any doubts on this? Yep. Can we proceed? Can we proceed? Now I get to the second plan, which is bonus plan, which is the bonus plan. Bonus also same problem. I started with 10,000, but I'm going to end with 20, 30, 40, 50, 60. Only good part is the calculation is not that heavy. It can be done faster. It can be done faster, but still the same problem. It has the same problem. I'll have to calculate what? Closing units. I'll have to calculate the closing units. Let's start. Working note 2, return of who has invested in a bonus plan? Mr. Anand, in bracket bonus plan. Return of Mr. Anand, bonus plan. Growth is the easiest, will take us least amount of time. That will take us the least amount of time. Note 1, computation of units on maturity. Units on maturity. I may need, I think, 4 or 5 columns. I don't remember. I think 5 columns could be there. Date, opening units, bonus ratio, opening units, bonus ratio, units allotted, closing units. Opening units, bonus ratio, units allotted, and closing units. Opening units, bonus ratio, units allotted, and closing units. Tell me the first day bonus is declared. 31, okay, 31 3 2004. We start with 10,000 units. We start with 10,000 units. There's a bonus declared of what ratio? 5 is to 4. 5 is to 4 means 5 units for every 4 units. 5 units for every 4. So on 10,000 you will get into 5 by 4. On 10,000 you will get into 5 by 4. 5 units for every 4 units. 5 units for every 4 units. Closing is 20 to 500. Closing is 20 to 500. 5 by 4. Clear? 10,000 into 5 by 4. When is the next bonus declared? 31 3 2008. What's the ratio? So opening is 20 to 500. 1 is to 1 is to 3. 20 to 500 into 1 by 3. 7,500, 30,000. Clear? I think one more allotment is there. When is that? Day 4, 3,000 units opening. Bonus ratio 1 is to 4. 3,000 into 1 by 4. We end with 37,500. On this allotment, there will be capital gain. There will be short term capital gain. On the short term capital gain, I'll have to pay tax, and cost of acquisition is 0. Short term capital gain, cost of acquisition will be 0. That is when you do calculation of capital gain, selling price will be whatever given in the question, purchase price will be 0. Purchase price. In case LTCG was taxable, for this 0, for the first one it is 10 rupees. For the first one it is 10 rupees because you're paying that money. The first one it is 10 rupees because I'm paying 10,000 into 10 rupees. But for these three, the cost of acquisition will be 0. Cost of ICI does put an asterisk mark and say you can alternatively take the cost of acquisition as the NAV on that date. As the NAV, they have put an asterisk mark and mentioned that. I checked with the tax faculty, they said cost of acquisition is 0 for a bonus unit. It is 0 for a bonus unit. So I'll follow whatever they mention. ICI has given both approach. One approach is 0 cost of acquisition. Second approach is whatever is the NAV of the bonus plan. NAV of the bonus plan. Let's start. Note 2, capital gain. Capital gain for units allotted within 1 year. Capital gain for units allotted within 1 year. Short term capital gain is equal to 7,500 into selling price minus cost price. Units allotted within 1 year. Units allotted within 1 year. The last allotment alone. The last allotment happened at 7,500. The last allotment happened at, sorry, the last allotment was 7,500, which is less than a year. Which is less than a year. Earlier allotment 31/3/2008. 31/3/2008. That allotment is more than 1 year. That allotment is more than 1 year. 24/3/2009 is less than a year. Less than a year. What is the selling price on the last day? Minus 0. Minus 0. 22.98 into minus 0. Let me know the amounts now. 1 lakh 70 50. Tax on STCG 17,235. When I do growth plan, the best will be there is no capital gain, nothing is going to be there because no new allotment, no units calculation. We are not going to do anything there. It's going to be straight away computation. Any doubts on 17,235? Any doubts on 17,235? Clear? You can do in your notebook exactly same format. I am doing it in the screen. Sale value on maturity less STT less STCG, net amount realized, amount invested, return in rupees, annualized return. Exactly same calculation. I am going to do it in the screen. You are going to do it in your notebook. Same calculation. Numbers obviously will be different. Numbers are going to be different. Sale value on maturity less STT less STCG tax, net amount realized less amount invested, return in rupees, annualized return percentage. Annualized return percentage. I'll keep explaining each of the item, but you can keep doing it. You can keep doing it. No need to even wait for my instruction. Sale value on maturity will be, this is in case you want to follow my explanation, follow it, else you keep doing it. I always tell students that you should not wait for my instruction. You do make mistakes and correct with a different pen. Make mistakes in the class, please keep making any number of mistakes, it's okay. Anyway, printed solution is given for only one purpose, that at the end I'm very sure that you will only be referring the book, you may not refer your notebook. So what you do is in the class, practice, 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 make mistakes, make mistakes. Don't wait for my instruction. 37,500 into 22.98 into 22.98, 2%, sorry, 0.2%. STCG tax was 17,235. 1 lakh invested, 742 earned. 1 lakh invested, 742 earning. 1 lakh invested, 742 earned. I think some of you have already done. Nothing new. And logically speaking, all the three should give almost similar returns. This, that is 67 you got. No, this also would be 68, 69 type only. It may be the drafting issue can be there in the question, but otherwise almost same numbers only. It doesn't really matter which plan you take. The only logic is very simple. If I am in need of money, I'll take a dividend plan. If I'm not in need of money, I'll take a growth plan. Bonus is of no use. 71.88 percentage annualized return, 71.88 percentage. If you are done, repeat the same table exactly for a growth plan where it is 10,000 into the price. That's all. No capital gain, nothing is there. It will be 10,000 into the NAV. 10,000 into the NAV. I'll do the growth plan also, but growth plan nothing is there. Growth plan nothing is there. Same table. Same table. 10,000. Same table. 10,000. It's no change in units. No change in units. No capital gain. No capital gain because STCG is not there. STCG is not there. Growth is the easiest of the lot. Directly you will do 10,000 units. Directly you will do 10,000 units. Any doubts on the bonus plan? Do growth plan. I'll do it in the screen. Return of growth plan. Return of growth plan. Exactly same thing. Only changes no STCG tax. No STCG tax. Return of growth plan. No units calculation. No units calculation. No capital gain calculation. Nothing is needed. Return of growth plan. Return of growth plan. Sale value on maturity less STT, net amount realized less amount invested, return in rupees, annualized return percentage. Let's do growth plan. Any doubts on the bonus plan? Anybody has any doubts on the bonus plan? Any doubts on the bonus plan computation? No dividend in bonus plan, no dividend or bonus in growth plan. The bonus plan will give you bonus units, dividend plan will give you dividend in rupees or dividend in units. Growth plan doesn't do any of them. It's basically pure, you invest and you get one money in the end. Sale value on maturity is 10,000 into the NAV, and this is the difference. I said no, the NAV will take care of it. The NAV will take care of it. Others NAV were lesser, units were higher. Now this NAV is very high, units is lesser. And practical example I showed, Parag Parikh Flexi Cap 150 rupees was growth plan and some 50 rupees was dividend plan, and that is because it kept on giving money. It kept on giving money to people. 10,000 into 82.07 STT 0.2%, 1641. No short term capital gain. No short term capital gain. Why no short term capital gain is very clear, because here no units got allotted after my initial purchase. And even see, in case they want LTCG taxable, at least growth is easy because only one purchase. For one purchase, you calculate the capital gain and calculate the tax on it. Multiple purchases becomes difficult. Becomes difficult. Net amount realized, amount invested, return in return in rupees 7 lakh 19,000, 7 lakh 19,000. 719059 divided by 1 lakh into 12 by 124 into 100. 12 by 124 into 100. 69.99%. Any doubts on this? Clear? All the three are almost similar numbers, but one major challenge is time value of money is ignored. See, less than a year, time value of money, no major problem. This and all, the real return here will be no, something like 30-40% only. If I calculate considering time value of money, it will be around 30-40%. How to calculate and all, we'll see later, but it will be only 30-40% type of a return rather than 69.59 which we are calculating, because lesser period, smaller period, time value of money will not impact, but longer period, time value of money has a huge impact. The time value of money has a huge impact. Any doubts on this? Clear? Can we proceed? Everyone done? Anyone doing it? I will wait for 2 to 3 minutes, go through the entire question. Any clarification, any doubts in any of the three plans, 2-3 minutes for you to go through the entire solution, go through whatever we have done till now. Let me know if there is a doubt. 2-3 minutes for you. Take 2 to 3 minutes. Okay, we'll proceed with the discussion. So, question 8 is a homework question which you have to do today, please, because tomorrow's session you will do return, but the answer will also need IRR calculation, which I will take you through in tomorrow's session. But for that, you have to do the computation and come. It's a dividend plan and a bonus plan. Dividend plan and a bonus plan. If problem is silent, it's dividend reinvestment. You will calculate units on maturity and do total value, no STT, no short term capital gain, nothing is there. Units on maturity, less amount invested, you will get your returns. All that's a normal calculation which I've done in this session. Only thing is there is going to be an IRR calculation. There's going to be an IRR calculation which I'll take you through. IRR calculation. You do normal return and come. You do normal return and come. IRR part I'll take you through. The IRR part I'll take you through. For IRR part only, this something is given below. Use following PV factors. That is going to help me in doing the IRR computation, which I will do it in the next session. But before that, you will have to compute that number, sale value on maturity, less amount invested, return in rupees, return in percentage, all that you will have to practice and then come. Any doubts on this? Any doubts on this question? So question 8 is homework. Okay, I'll come to question 9. Will not be able to do the full part of it, but I'll do a part of the question today and part I'll do it in the next session. Uh, Messrs Corpus and AMC on 1/4/2015 has floated two schemes: dividend dividend plan means dividend reinvestment, understand it as dividend reinvestment, and bonus plan. Mr. X, an investor, has invested in both the schemes, following details except the issue price are available, except the issue price are available. I don't know what is the issue price. I have no idea what is the issue price. Because they have asked, I cannot say it is equal to 10 rupees, because some students said I'll take it as 10 rupees new fund offer. No, they are asking issue price. You cannot just make that assumption and proceed. 1/4/2015, the day zero price is question mark. 31/12 bonus is there. 31/3 dividend is there. 31/3 dividend is there. 31/12 bonus is there. 31/3 dividend is there. 31/3/2020 investment 9 lakh 20, 10 lakh rupees. Only thing I don't know is 9 lakh 20 is broken down into how many units and what issue price. Average profit means profit per year. The term average would mean average annual profit, average profit per year. Average yield, you are required to calculate what? Issue price of both the schemes on 1/4/2015. Now, what is this question? Today I'm going to do bonus plan. Tomorrow I'm going to do dividend reinvestment plan. Now listen, what is going to happen here is, for the bonus plan, I'm assuming the first column is the first column is dividend, second column is bonus. My return is 6.4. What will happen here is, we'll start with this table. I have 6.4. I'll calculate return in rupees. I have amount invested. I will know net amount realized in the reverse order. Once I get net amount realized, net amount realized is whatever number of units, I don't know, into 44, number of units into 44. I have closing. From closing, go in the reverse order and go to the opening of day zero. Entire calculation is in reverse order. Entire calculation is going to be in reverse order. When you look at in the forward order, it will be very simple. But when you go in the reverse order, it will become a little tricky. So when it came in exam, student again struggled because entire calculation was to be done in the reverse order, and this type of question has come one more time in exam. They ended up asking. My entire computation will now go in the reverse order. First, I will calculate closing value. What is the use of closing values? Closing values 44 into closing units. So I will first get the closing value, get the closing units. Closing units is equal to whatever, there is a bonus declared on this date, there's another bonus declared, so I'll have to keep doing calculation, but everything is going to be now in the reverse order. Once you get to day zero figure, you will know the day zero units. 10 lakh divided by the day zero units will give you the issue price. Any doubts on this? Can we proceed? Let's start. Working note 1, analysis of bonus plan. Dividend I'll analyze in next session. Analysis of bonus plan. Period of investment. First get me this, because this will help me in calculating some of the calculation. Period of investment. We invested on 1/4/2015. 1/4/2015. Maturity is 31/3/2020. We invested on 1/4/2015. Maturity is 31/3/2020. 5 years. 5 years is my investment. It's exactly what I did in the earlier calculation, but slightly in a different manner. That's all. This part you have to take care. Ideally, I should not be doing this question. But if I tell you to do at home, you will struggle. I know, because the reverse working, this is a more complicated reverse working. But technically, I'm not going to teach anything new here. Period of investment 5 years. Annual return. Average yield is annual return. 6.4%. 6.4%, 6.4%. This basically mean I'm going to earn 6.4% every year, and in 5 years I would have earned 32%. In 5 years I would have earned 32%. In 5 year period I would have earned 32%. 6.4% is annual return. Every year I'm earning 6.4%. I had given you one formula: holding period return and annual return linkage. Holding period return and annual return linkage. Annual return can be converted into holding period return. Holding period return can be converted into annual return. Why are we calculating this? Because in the end we earn not 69.59. 69.59 was for 1 year. What we earned in that question was 7 lakh 19,000. 7 lakh 19,000 on an investment of 1 lakh. On an investment of 1 lakh. So today I'm not earning 6.4% on 10 lakh. I'm going to earn 32% on 10 lakh. I'm going to earn 32 percentage on 10 lakh rupees. On 10 lakh rupees. My investment amount is 10 lakh. My investment amount is 10 lakh. 6.4% is for a year. First year 6.4, second year 6.4, third year 6.4, fourth year 6.4, fifth year 6.4. So on 10 lakh I earn 1 year 6.4, second year 6.4, third year 6.4, fourth year 6.4, fifth year 6.4. Put together I earn 32%, and 10 lakh would have become something. 10 lakh would have become something. Next, return for 5 years. Return for 5 years is equal to 6.4% into 5. Any doubts on this? 32%. Maturity amount. Maturity amount is equal to 10 lakh plus 32%. Maturity amount is 10 lakh plus 32%. For the other plan, they have given amount in rupees, 10 lakh plus the amount in rupees. 10 lakh, whatever, it's not 10 lakh, that is 9 lakh 20, but I'll come to that later. 10 lakh plus 32%, how much? 13 lakh. I want to break this as in 13 lakh 20, right? Closing price, closing units, or closing NAV into closing units. Closing NAV into closing units. My maturity value is closing NAV into closing units. No capital gain, no securities transaction tax. Very simple. Last question we did 10,000 into something like that growth plan. Here closing NAV into closing units. Closing NAV is there in the question. How much? 44. Closing units is balancing figure. 44 is the closing NAV. 44 is the closing NAV. 44 is the closing NAV. The closing units we get. Any doubts on this? Clear? Can you proceed? Any doubts on this 30,000 number? Done. Now I'll have to go in the reverse order for every bonus. Reverse order for every bonus. Forward order will not work. Reverse order. Last bonus, then last to last bonus, then last to last bonus. I'll have to keep going in the reverse order. Somewhere I'll get the opening units. Any doubts on 30,000? Any doubts on 30,000 number? 44 into 30,000 units. Next. Tell me the last bonus date. When was the last bonus declared? 31 12 2018. Closing units is equal to opening units plus bonus units. Opening units plus bonus units. Closing units is equal to opening units plus bonus units. I'm again repeating, I am doing exactly the same thing. I'm not doing it in table. If I do in table, you will find it a little difficult to understand. Else I could have done it in the table itself. But I'm doing in the table, this is what we were doing. You see the calculation. Closing units is equal to opening units plus units allotted. All right, 30,000 is equal to 30,000 is equal to x plus x plus. What is the bonus ratio on 3112? 1 is to 5. So x plus 1 by 5 of x. X plus 1 by 5 of x. X plus 1 by 5 of x. Clear? Any doubts on this? X plus 1 by 5 of x. I don't know the number. You calculate. This will give me the closing units for 31 to, sorry, opening units for 3112, and I go in the reverse order. I keep going in the reverse order. I'll repeat again. Closing units is equal to opening units plus bonus. Opening units plus bonus. 30,000 is equal to 30,000 is equal to x plus 1 by 5 of x. Solve and let me know the x. Now you will find it easy to understand. We had 25,000 units. 1 by 5 got allotted. 25 became 30. 25 became 30. I had 25,000 units. Easy. Forward is easy for me to explain. Backward is little time consuming. It's the concept does not change. The difficult part is you are not able to visualize it easily. So that is why suddenly you get into a trouble. But otherwise concept remains same. It is 25,000 plus 1 by 5 plus 1 by 5, which is 30,000. Doesn't end here. Before this, when was the bonus? 31. Again same thing. Closing units is equal to opening units plus bonus. Closing units is equal to opening units plus bonus. Closing units is equal to opening units plus bonus. Closing units plus bonus. Now closing units is 25,000. Opening is x. Opening is x. Closing is 25,000. Opening is x. What is the bonus ratio on this day? 1 is to 1 by 4 of x. 1 by 4 of x. It's very simple calculation. If I have one more bonus, I analyze that. If not, this kind of takes care. 1 by 4 of x. Any doubts on this? What is the number? I can put it in the table. Start with 20,000. 1 by 4, 5,000, 25,000. 25,000, 1 by 5, 5,000, 30,000. Any bonus before this? Is there any bonus? So my opening units is 20,000. My opening units is 20,000 and my issue price is 10 lakh divided by 20,000. My issue price is 10 lakh divided by 20,000. Again, I'm repeating, I've just done it in the reverse order. I have not done anything new here. I have not done anything new here. Our objective is, as you practice more and more, somewhere grip has to come in the reverse working as well as forward working is very easy to do. Reverse working, I will not say very easy, but sometimes you will find it complicated at places. But if clarity is there in the concept, you'll have to keep going in the reverse order. Keep going in the reverse order. Any reverse working question, I keep saying this, once you are done, unless it's a very complicated calculation like dividend reinvestment, other things you can quickly check. 20,000 plus 1 by 4 plus 1 by 5, check the number. Bonus is easy to check. Reinvestment in Excel, I can check it easily, but at your end, it can take time. So, but reinvestment also reverse order, which I'll discuss in the next session. Reinvestment reverse calculation, I'll discuss it in the next session. So, this number is right. Issue price is equal to 10 lakh divided by 20,000. 50 rupees. Ideally, I should have got 10 rupees only, but okay, question has not given and they have told us to compute because normal face value is 10 rupees. Normal face value is 10 rupees. So when you issue, you'll issue it at 10 rupees. Question has not told me that. They have told me to calculate the issue price. I've done it in the reverse order. I've done it in the reverse order. Same question. What we did in the previous problem is they gave you 50, they gave you 10 lakh, they gave you 20,000. From 20,000, you calculated 30,000. You did 30,000 into 44, got 13 lakh 20, deducted 10 lakh, got 3 lakh 20, and got finally 6.4%. Now I have given you 6.4. You have to do everything in the reverse order. Everything in the reverse order. Any doubts on this? Any doubts on this part? Just give me a minute. Okay, I think we are kind of done with today's session. Any doubts anywhere there, you can let me know. You can let me know after the class also your doubts so that I clarify them, or send me a message in WhatsApp. I'll clarify there. That question which I told you, please do it today. Don't come back to me saying that we couldn't find any time. I'm not here to listen to all that, because if you're not doing that, then you'll not understand my explanation, which I'm going to do on the IRR part. So please complete it. Next session, I'll discuss first this question and then I do that IRR part. We'll end with this.